Now let's talk about how different strike prices can influence the premium on the options. First, let's assume we have three different strike prices. K1 is the lowest, K3 is the highest, and K2 is in the middle. And the premium or option price relationships that we are talking below can be applied to both European options and American options. For the rest of this discussion, all the options we are talking about only different in the strike prices. They have the same underlying, they have the same expiration date. So let's look at the premium levels. We know that if a call allows you to buy at a lower price, then it's a better call. Right? A call allows you to buy a stock at $80. It's a better call than another one allow you to buy at $100. Right? You have to wait until the price go above $100. The higher strike call will be in the money. So as the call strike goes higher, right, the call premium will decline. You can also say lower strike call costs more, but basically, as the call strike prices become higher, the call premiums will decline. This is the opposite for puts. Okay, we know that put options are insurance, and for good insurance, it's better to start to pay out for damage at a higher level. So if the strike price on the puts are lower, then the low strike puts will cost less. In other words, as the strike price in puts become lower and lower, right, the put premium will decline. And for calls, as the strike price become higher and higher, the call premium will decline. Now, let's think about the premium gap, right, for different strikes, and the gap in the strikes. Right? K1 minus K2 is the change in the strike price. Or let's say the difference in the strike price. How that will influence the premium difference. Again, lower strike call cost more. So the low strike call is higher than the high strike call. So CK1 minus CK2 is a positive number. Okay, that's the difference between the two calls with different strike. Now, this premium difference is less than the difference in the strike price, K2 minus K1. For puts, the high strike put will cost more. So PK2 minus PK1 is a positive number because the strike price for PK2 is the higher one. Again, the difference between PK2 and PK1 is less than K2 minus K1. If we are talking about the European options, right, we are using the capital letters for the calls and the puts here, so we are talking about American options. But if we are talking about the European options, the difference between the two strike should be replaced by the present value of the two strikes because you can only exercise the European options on the expiration date. You have to discount the strikes, even their differences from the expiration date to the current time. Now let's look at some proofs. These proofs very interesting. Okay, they actually will invoke some of the option strategies we have talked about before. So let's talk about the effect of changing in strikes on premiums. And again, we know that for higher strike, if the K2 is higher than K1, you have the premium for K2 is higher than the premium for K1. Now, let's say the market violated this situation. Assume that the low strike put is actually selling higher at a higher price than the high strike put. Then we can start to make money. Whenever you see this kind of situation, sometimes they may not be very obvious, but if you see it, it's a good chance to make arbitrage profits. So obviously, to do arbitrage, we do the same thing as always. We will buy low, sell high, right? Which one is the higher one? The low strike put is higher. So we are selling the low strike put. And with that proceed, we can purchase the high strike put. Buy low, sell high. Right? The buy low, sell high. So in terms of position, right? In terms of a position, we look at a long in the high strike put and a short in the low strike put. The second column is for cash flow, right? We paid for the premium for the high strike put, and we have received the premium on the low strike put. And remember, because we assume the low strike put cost you more money or actually generate higher proceeds, right here, we are selling it short. So you actually make money upfront. And then let's look at what's going to happen at the expiration date. This is very easy to discuss, even though the table looks complicated. It's just different underlying price at the expiration date at different levels, right? The third column, we look at the underlying price is lower than the low strike price on the expiration date. Now, both are puts. Remember, both are puts. Since both are puts, right, low underlying price means both are in the money. So your long high strike put is in the money. What it give you is K2 minus the spot price. And then the low strike put is also in the money. Its own payoff is the low strike minus the underlying stock price. That's okay. But since we are shorting it, right, it's in the money, we have the obligation to pay that payoff. So it's a liability. So it's the negative of K1 minus the underlying stock price. Now we can sum them up. What do we have is K2 minus K1. Okay, because in long high strike put, we received this high strike and we delivered underlying. But through the low strike put, the short low strike put, right, we have to accept K1 and receive the underlying. So the underlying come in and go out. The underlying is gone. All that we have is the difference between K2 and K1. So that's one scenario. And then let's look at the second scenario, the fourth column. The underlying price is right in between the two strike prices, right in between. But since it's higher than the low strike price, the low strike put is out of money, so the payoff is zero. We don't need to consider it. We have no liability whatsoever. For the high strike put, we have a long position. It still gives us K2 minus the underlying price at the expiration. Now, that just gives us a payoff of K2 minus the underlying price on the expiration date. Notice this is also a positive payoff. The last column, let's think about when underlying price goes beyond the high strike. And now, even the high strike put is out of money. Neither of my long short puts are in the money. Both payoffs are zero, so I got zero payoff in total. So what we can conclude now, right? Using the arbitrage strategy, we are selling the low strike put and buying the high strike put, which kind of the pricing relationship is in reverse, which make money up front, right? We made money up front, and then wherever the expiration price of the underlying goes, we will be either in positive payoff or zero payoff. We have non-negative payoff for all the possibilities. The result is that I receive the money up front, and then I can still receive money in the end, or receive nothing. But that basically means the money I received up front is free. That's an arbitrage profit for sure. And indeed, the money can be even higher if the stock price go below the high strike. So this shows, right, a low strike put should cost less. It's a worse insurance. It should cost less than a high strike put. And let's look at this strategy, right? We are buy high, selling low, right? In the put option, right? Buy high strike, selling low strike. Now this is a put bear spread, and this bear spread is making money in all possible states of the world. It's free lunch. Okay, this is the way we can prove that the option premium relationships have to obey certain rules. For the puts, lower strike give you lower price. For the calls, right, lower strike price means higher call premium. And to prove that, you can do this as an exercise. Think about bull spread using calls, and to see you should be able to receive money upfront, and then the payoff in all states of the world are non-negative. Now let's look at the differences in premium and the differences in the strikes. Right? Still, what do we know? What we are seeing here is that the difference in the strike, right? We have discussed this. For put option means the premium for these two puts is smaller than the difference in the strike prices. Again, we do the same thing. This same argument. We assume this condition is violated. Now this one is not as obvious as the previous one, so maybe you can really see it in the market, right? Take a look at the difference between the two premium and look at the difference between the two strike. You see there's a violation there. Then what do we need to do? Still buy low, sell high, right? Buy low, we buy this difference in the strike, right? We are assuming the difference in the put premium is higher than the strike difference, so we need to buy the strike difference, which means basically we invest in a bond, right? Invest in a bond for that difference, for that amount. When you invest in a bond, it basically means that you're lending money. Okay. You're lending money at the risk-free rate. Now, for this higher differences, right, in the put premiums, what do we need to do? We are selling high, right? We put a negative sign before the left-hand side. So we will short the high strike put here, short PK2, right? And another negative sign in front of PK1 means that we are taking a long position. We're taking a long position in PK1. So if we summarize our position, we are buying the low strike puts, selling the high strike puts, and we lend out the difference between K2 and K1. That's the first column. What about cash flow? Right? To pay for the low strike put premium, that's the cash outflow, and then because we are selling the high strike put premium, we receive money. Lend out K2 minus K1 means this money is also going out. There's a negative sign before the difference between the strike prices, so it's called cash outflow. And then we summarize this. What do we see? It's the difference between the put premiums minus the difference between the strikes. Okay, we just assume that the put premium difference is higher than the difference in the strikes, and now we actually created this cash flow, which is positive. Again, this is a situation where we do receive money upfront, right? Also, if we look at the put option strategy here, we are buying a low strike put, selling a high strike put. That is actually a put bull spread, right? A bull spread using put options. And then obviously we are using the proceeds to lend out, money. Now, just to remind you, this proceeds should be positive. It should be positive. All that we are saying is that this proceeds, right, from selling the high strike put and then pay for the low strike put, what you left, that amount of money should be less than, not higher than, the difference between the two strikes. Okay, then we can discuss these different situations. Still, let's start with the underlying expiration price fall below the low strike. So again, both options are in the money. Your long low strike put give you K1 minus the underlying price at the expiration, and then your short high strike put give you the negative of K2 minus the underlying price at the expiration, ST. Because you have lent out K2 minus K1 from the start, what you have is the future value. And you lend it out, you should earn a risk-free rate. It's the future value of the difference between the strikes. Now, what you have received is, on the lending, you have received this future value. Right? On the bull spread, put option bull spread, it's the similar story before. Okay, the similar story before. What we have is actually minus K2 minus K1, because in the previous discussion, when we talk about the different premium levels for different strike prices, it's a bull spread. It's a bear spread. Now we're talking about bull spread. The bull spread, the payoff is reversed. So you actually have the negative of K2 minus K1. And then what we're looking at for the total payoff is the future value of the difference in the strikes minus the difference in the strikes, as long as the interest rate is positive. Okay, as long as the interest rate is non-negative, this one should be a positive number or at least a 0. So that's when the underlying price is below the low strike. If it falls between, again, the low strike put is out of money. The high strike put is in the money, but we have shorted it, so it's a liability. It's the minus of K2 minus ST. That's a liability. But because the underlying price at the expiration now is actually closer to K2, the higher strike price, right? It goes above the low strike, but still below the high strike. It's a smaller difference, right? The high strike minus the spot, the underlying price at the expiration is a smaller number. And then from our lending of the difference between the two strikes, what do we have? We have the future value of that difference. Again, that at least should be just the difference itself, and can be higher if you have positive interest rate. So the total payoff when the underlying expired in between the two strikes is the future value of the difference in the strikes minus how far the underlying fall below the high strike. Okay, again, that's a smaller number. This says what? This says basically if the underlying fall between the two strike prices, you have a positive payoff. So the first one is at least non-negative, right? At least 0. This one, can be borderline situation. Yeah, it can be 0, but once it's in between, it must have positive payoff. Now, look at the underlying price expired beyond the high strike. Both put options are out of the money. And the only payoff is the future value of the difference in the strike. That in itself is a positive number. So if you summarized the last row, right, the total says what? At time 0, I have some cash coming in. At the expiration, in wherever the underlying end up at, right, whatever the underlying price level is at the expiration, I have either 0 or positive money. This is again arbitrage profit. Okay, as long as there's no negative payoff in some of the states. As long as that is the case, this is an opportunity to make arbitrage profit. So this actually shows us, right? It proves to us that the difference in the strike prices should be higher than the differences in the option premium. Now let's talk about the so-called convexity of option prices with respect to strike price. So again, we consider 3 different strike prices with K1 is the lowest, K3 is the highest, K2 is the one that is in the middle. And this convexity relationship in strike prices is true for both European and American options. And we are using American options here as an example. So let's look at from K1 to K2 and K2 to K3, right? We have this inequality. It says basically the change in the lower range strike price as for the call premium and as a portion of the strike price themselves. And this is the lower premium range. This change is higher than the change in the call premium when the option strike price level is higher, K3 minus K2. That's a higher um, higher option strike prices range. Right? The left hand side is the change in call premium as a portion of the change in strike prices on the lower end. The right hand side is the change in call option premium as a portion of the strike price changes on the higher end for the strike prices. So that's what this inequality is saying. And as we have seen before, go back, right? We know that the change in the call premium is less than the change in the strike price. So both sides of this inequality is less than 1. And what we have is that, let's say, from K2 to K1, K3 to K2, the change in strike is both $10. The call premium change from K2 to K1 is $5. Okay, so on the left hand side, it's a half. And then on the right hand side, the call premium change from K2 to K3 will be below $5. It should be either $4, $4.50. It's some number below $4. Okay, the call premium as the strike prices become higher and higher, the call becomes cheaper and cheaper. But how much cheaper? It won't cheaper by the whole change in the strike price. It will become cheaper, less and less than the previous decline in the call premium here. It's not even compared to the strike price. It's compared to the previous decline, right, in the call premium. So we can summarize a little bit. What this one is saying is that because for calls, right, when you have progressively higher strike prices, the premium will decline. We know that, but the declining rate is decreasing. Okay, so the call premiums decline at a decreasing rate when the strike prices are progressively higher. In terms of picture, we look at this picture. It's this downward sloping cross line. Right? It's a curve with cross marks. And what it says is basically as the strike price becomes higher and higher, right? This option premium line goes to 0, right? But it won't fall below 0. So when it's getting really, really close to 0, it has to have this convex shape because it doesn't go straight line down. Right? If it goes straight line down, somewhere it will hit 0 or even go below. That we know option has values. It cannot be negative. So when you increase the strike price, yes, the call become worth less and less, but it's just still above 0, or getting very, 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 very close to 0, but it won't be fall below 0. That's sort of give the basic nature of this relationship. For the put, it is this positive sloped curve, okay, with diamond marks. Okay, it's positive slope curve. Let's look at the puts. What are the puts saying? Again, for puts, right, from K1 to K2, K2 to K3, the strike price become higher and higher. And well, if we contrast with call, right, from K3 to K2, K2 to K1, the strike become lower and lower. And then as the strike in the put option become lower and lower, the put premium become cheaper and cheaper. So yes, we know PK3 is higher than PK2, and that premium drop is for the strike price drop from K2 to K3. And PK2 is higher than PK1, but if you have the difference between the two premium, is for the strike price drop from K2 to K1. Again, the change in the lower strike price range for the put premium is less than the premium decline for the higher strike range in the put premium. Okay. So we are still talking about a declining rate in the premium change or decreasing rate in premium decline. But because for put, is the lower strike puts have a cheaper premium, it go with a positive slope in the picture. In other words, if you have higher and higher strikes, the change in the put premium will become faster and faster. Right? If the put premium, right, if the strike price in the put options become higher and higher, right, the premium increase will be at a faster rate. That's what give you this positive slope in this convexity picture for the put option premium. But if you want to understand where this convexity comes from, still you kind of go to the lower strike part, right? The kind of lower premium part. You see when the strike price declines, right? The put option still should have some value. Its value becomes smaller and smaller, but it does not fall below zero. Right? Fall below zero is getting closer and closer to zero, which basically just drag it flat, make it a convex shape, not a straight line nor a concave shape. So that's the convexity. That's the convexity. That's what it is, and we are going to prove it. We're going to prove it. To prove it, we will need to do a little bit math. We just need to manipulate the symbols a little bit to get the result. So first we consider, the middle strike. We design a middle strike or define a middle strike as a weighted average of K1 and K3, right? It's somewhere in the middle, depend on this parameter of lambda where K2 is, right? You go up from K1 by lambda and then sort of go down from K3 depending on lambda. Meet in the middle, get your K2. So K2 we define as K1 times lambda plus 1 minus lambda times K3. It's basically will give you the idea where K2 is in between K1 and K3. Now, once that is set up, we can look at what we had before, right? We have this K3 minus K2, K2 minus K1. So at least we want something like K3 minus K2. And from our formula, we can actually get it. It will just be lambda times K3 minus K1. Okay, K3 minus K2 is lambda K3 minus K1. The whole gap between K3 and K1, lambda of it will be the difference between K3 and K2. Now, because basically we start with K2, right? Now we can actually define lambda. Where do you get lambda? Lambda is K3 minus K2 over K3 minus K1. Lambda is the portion, right? How far below K2 is to K3 as a portion of how far below K1 is to K3. That's lambda. So basically, you can understand lambda is how far K2 is from K3. And with similar manipulation, we can get K2 minus K1, okay, is actually 1 minus lambda this weight, 1 minus lambda times K3 minus K1. So how far K1 is from K2 is 1 minus lambda portion of the total gap between K3 and K1. Now basically we have expression of K2 minus K1 as a portion of K3 minus K1, and K3 minus K2 as a portion of K3 minus K1. And we bring lambda times K3 minus K1 and 1 minus lambda times K3 minus K1 to the denominators. That actually link up, right? For these denominators, we put in lambda as a portion of K3 minus K1 and 1 minus lambda as a portion of K3 minus K1. So 1 minus lambda is for the denominator for lower strike range put premium change, and lambda will be the denominator for the high strike price range put premium change. And again, we do rearrangement of the symbols times the right hand side lambda to the numerator on the left hand side, and times the 1 minus lambda on the left hand side to the numerator on the right hand side. And what do we get? We basically get the premium of K2, right? The premium of the middle strike is less than the combination of the premium of K1 and the premium of K3, still depending on lambda. And lambda still apply to PK1 and 1 minus lambda apply to PK3. Okay, this is actually the standard definition for convexity, right? If you look at our picture, just think about this convexity. If I link up a straight line, that will be a weighted average of two put premium, right? And the actual put premium for strike prices in between 2 points on this line will fall below the average, right? The average will be a straight line, and the actual put premium will fall below that straight line. That's what this last formula inequality is telling us. That's the standard definition for convexity. Right? The kind of, if you think about a function value, right? The value of the function for the middle point is below the average of 2 points. The value of this function at 2 points. Take the average, and that's lambda pk1 plus 1 minus lambda pk3. Okay, that's our mathematical derivation. What does it do for us, right? This is actually our conclusion. This one has to hold. This inequality has to hold, and it gives us the convexity. To prove that it has to hold, we certainly assume it's not the case, right? We assume this middle strike put premium is actually higher than the average premium for the high and low strike prices. So what do we do? If this is the higher one, this is the lower one, we certainly buy low, sell high. We buy the weighted averaged different strike premiums and sell the middle strike premium. Okay. And we know when we are doing that, right, we assume the middle strike premium is higher than the weighted average of the two high strike, low strike premium. We know that when we are doing this arbitrage, right, we shorted a high price, paid a combination of two low prices. Actually, the combined prices will be low, right? We are making money up front. And we have seen this one before. It's actually an asymmetric butterfly spread. With our knowledge, right, what do you get for asymmetric butterfly spread? We know that if the underlying price falling outside K2, K1, and the K3, right, outside of the broad range, the payoff is 0. And at K2, the payoff is the highest. If it's moved from K2 to either K1 or K3, the payoff will decline towards 0. But once it hit the two strike prices, the high strike K3 and the low strike K1, once they hit those 2 points, the payoff will be 0. In other words, for this asymmetric butterfly spread, we know that the payoff are non-negative. Non-negative payoff with money upfront, it's free lunch, it's arbitrage opportunity. Okay, that's something we have known, and we can still use our technique before, right, to think about what we have here. This is a good exercise. This is still a good exercise. And what we have here, we short the middle strike put, right? This is short middle strike put. We take long in lambda pk1 and long in lambda pk3. So the top inequality here is my cash flow. My cash flow upfront at time 0 is positive. Okay, this is a cash flow, and the trade listed, the trades, different trades listed in the first column. Those are my positions. And then obviously I'm going to summarize the payoff for different underlying price level at expiration. Right? Again, we will start with the underlying price for below K1, below the lowest strike. The payoff for the long low strike put will be lambda times the payoff for PK1. Right? And for the high strike put, K3 minus the underlying price at expiration, right? That times its proportion, the weight, 1 minus lambda. Those are two positive payoff. And for the short middle strike put, it's the negative of K2 minus the underlying price. So that's my payoff. That's my payoff. And what do we have? We basically have long puts. Right? Long puts, we receive the strike and deliver the underlying. So from the long high strike put and the long low strike put, we delivered in total 1 unit of the underlying stock. For the short put with middle strike K2, we actually have to pay, we have to deliver K2 and receive this underlying. Right? From the long option, long put option positions, we delivered 1 unit of an underlying, and from the short put option position, we received 1 unit. So that all this underlying stock is gone. And then we count our strike prices. It's a lambda K1 plus 1 minus lambda times K3 and minus K2. Okay, that's by definition is 0, by the definition of lambda. That's 0. That's our equality to start with. Now think about the underlying price for between K1 and the K2, right? Kind of on the lower range for the asymmetric butterfly strike price. And because the underlying is above K1 now, the put option with K1 as strike price is out of money. The high strike put still in the money, so 1 minus lambda times K3 minus the underlying price at expiration still there. And the short middle strike put is still there, so we just need to sum up these two payoffs. And what it is, turns out this payoff when the underlying price is between K1 and K2 at the expiration, right? It can be expressed as lambda times the expiration price of the underlying minus K1. It's basically lambda times how much the underlying is above K1. And with this star here, I actually spell out the calculation. It's not that difficult, and you can read it by yourself. It just says what? Because the underlying price is above K1, ST minus K1 is positive. You get lambda portion of that, it's still a positive number. Okay, so if the underlying at the expiration is below K1, you got 0 payoff. If the underlying price at the expiration is between K1 and K2, you got some positive number. That's what we got so far. How about the underlying is between K2 and K3, right? On the higher range for these 3 strikes, still the low strike put is out of money. The middle strike put is also out of money because the underlying is higher than K2. You shorted the put option with K2 strike price, it's out of money, no obligation anymore. Now, only the high strike long put give you payoff. It's 1 minus lambda, that weight, times the difference between K3 and the underlying price at expiration. Because we know, or say we have assumed the underlying price at expiration is below K3, we know that, we will have a positive number. This positive number times 1 minus lambda, which is a positive weight, still positive. So again, we have a situation where your payoff is positive. Now, how about the underlying is above the high strike, right? The last column in this slide. When it's above the high strike, every single option in your strategy is out of money. Low strike put, high strike put, middle strike puts, all out of money. Payoff 0 again. And this really tells us the payoff structure for the asymmetric butterfly spread. That's good. But the basic conclusion is that with proceeds upfront, if this convexity input option premium is violated, right, you can set up this arbitrage strategy, get money upfront, and receive non-negative payoff wherever the underlying price goes at the expiration. That's arbitrage profit. It's a violation of the arbitrage-free pricing principle. It's a violation of the law of one price. So in that way, we proved the option prices, right, for put option premium, it has to follow this convexity with respect to the different strike prices. You can try the same proof for call option. In the textbook, the author actually gave you 2 numerical examples with more numbers for the same arguments, okay, for both call options and put options. Now let's look at one numerical example using the inequalities we have discussed before. What do we have here? We have K1 less than K2, still two different strike prices. And the high strike call is in the money. Right? The underlying prices went really high. And basically, if high strike call is in the money, then low strike call is also in the money. Also, we assume it is optimal to exercise the high strike call. This means that it is also optimal to exercise the low strike call. Okay, so high strike call, which is worse, right, relatively not so good option compared to the low strike call. And let's assume if the high strike call is in the money and optimal to exercise, it means it's also optimal to exercise the low strike call. Right? Low strike call sort of give you more money when you exercise it, given the same underlying price. Okay, let's look at that. Again, we know what? We know the difference in the call premium is less than the difference in the strike. So rearrange it a little bit. What we have is that the call premium, the low strike call premium, is less than the difference in the strike price plus the high strike call premium. Okay, so you have the difference in strike plus the high strike call premium. The sum is higher than or equal to the low strike call premium. In other words, the low strike call has an upper bound. The upper bound is the low strike call premium has an upper bound, which is the high strike call premium plus the difference in the strikes. Now, for example, K1 is 40, K2 is 50, difference is $10, underlying price is 70. So obviously, both options are in the money. Now, if it is optimal to exercise the high strike call with a strike price of 50, right, then the high strike call's value is 70 minus 50. You want to exercise it, is the payoff from that is 70 minus 50, which give you $20. Now, let's calculate the upper bound for the low strike call, call with a strike price of 40. What do we have? The difference in the two strikes, 40 to 50, is $10. And then the value of that high strike call is $20. So it's $10 plus $20, which equal to $30. And that is actually its intrinsic value. If you exercise this American call, right, with a $40 strike, now it's 70 minus 40. That's exactly what it's worth. So it's basically saying what? The low strike call already reached its upper bound. You're at the upper bound. Get the money. Right? It's optimal to exercise it. Same story is true for the puts, and we don't need to go too deep into that. But this is one application. This is one application for this inequality.